what we're aiming for today is understanding how to maximize deductions, and in doing it in a way that doesn't trigger any audits and kind of gives us the best of both worlds. So first, if we're talking about deductions, we've got to understand basically three major questions about anything that we want to deduct. The first one is it ordinary and necessary? These are the two-part test that we have to pass. So ordinary and necessary in the ongoing operations of a business. There's an example that I give often, and I apologize if any of you have already heard this, but it is one of the ones that I think illustrates it the best, which is we had a client a couple of years ago who's a dentist, and he wanted to deduct a tractor. And for like, a tractor is not an ordinary and necessary expense for a dentist office. However, what he did was said, well, what would a tractor be an ordinary and necessary expense for? It's an ordinary and necessary expense for a lot of different companies, including a property management company that's doing landscaping. So he owned his building, and he formed a family management company, a partnership, separate entity that was formed to manage real estate. And it managed his office. It managed a rental property that he also had. And because a tractor is an ordinary and necessary expense for this business, it allowed him to deduct the tractor under that other entity. So we have to be thinking through, is the thing I want to deduct ordinary and necessary? If it is, great. If it isn't, then we move on to the next thing, which is ask how, not if. So is it ordinary and necessary? Yes or no. But then how could we make it ordinary and necessary if it isn't? So the example I give on this one a lot is, we actually earlier this year, there was someone who owned a plumbing company with her husband, and she bought a new car. It was probably a $60,000 car, and she was concerned that she wasn't going to be able to deduct the car because she worked out of her home office and wasn't driving like a lot. She wasn't customer facing. So she was doing admin and doing it mainly from her home office. But in like twisting the question around and asking not, can I deduct this, but how can I deduct this? She was able to set up a mailbox that was on her daily route. So she was driving her kids to school every morning, and then she would come home. So on that daily route, so the majority of her miles are kind of on this consistent little route. And she got a mailbox for the company that was right along that route. So every morning when she left, after she did this, she was accumulating business miles from her home office, which she had established as a home office through an accountable plan through the company. And so she was leaving a business location, driving to a mailbox to check the mail for the business, another business location. And then she would drive from there a block to go drop her kids off. And in doing that, and then she would drive home, right? So the to and the from are all business miles. Now, the only thing that's not is the immaterial piece of like going, a block over to drop kids off. So she added up a bunch of business miles and reduced the portion of that trip that was personal down to a very small amount. And in doing that, now, 85% of her miles were business miles for this car. So that's a $60,000 car and 85% of it deductible. So that, roughly a $50,000 deduction, like pretty significant, just by changing a few things up and like thinking about that question differently and saying, okay, I need to get it to ordinary and necessary for business. How do I do that? And by approaching that question from a different angle, it allows us to set up the circumstances in a way that enables the deduction to be legitimate. And that really, that reminds me of a quote from Tom Wheelwright, who is kind of the one of the OGs of tax planning, and he has a really good book. And one of the things that he says in that book, and says often, if you ever get a chance to hear him speak, is that in order to change your taxes, you have to change your circumstances. Like, that is completely true, because it has to actually be ordinary and necessary. And in order to change your circumstances, you have to think about these things proactively and say, okay, I'm not going to, like, just because it isn't deductible exactly the way that I'm set up right now, doesn't mean that it couldn't be deductible if I were willing to, like, think about this and put a little effort into adjusting my circumstances to make it ordinary and necessary. And that leads to the next item, which is juice versus squeeze. There's some deductions are worth it, and some aren't. Right? You could go to a lot of trouble to set something up to be deductible. A classic one is like a camper or a recreational vehicle. It could totally be deductible if you're willing to set it up in a business. And there are other ways to do RVs or campers. This isn't the only way, but like the easiest way to do it is to make it deductible and cut and dry, is if you're willing to basically put it inside of your own little rental company. And if you do that and rent it out, then it's deductible. But for a lot of people who are in a position to buy something like that, and they're, kind of, it's a luxury purchase. It's a first world problem. How do I deduct my RV? You've got to, like, ask yourself the question of, but do I want other people sleeping in it? Do I want to have to, like, rent it out? Do I want to have to go through all that? And the answer is, like, maybe not. It really depends. It depends how bad you want the deduction, like how much you're willing to change your circumstances in order to justify the deduction. And sometimes it's worth it, and sometimes it isn't. But a lot of times these deductions add up to huge amounts of money. And the only way that you can know any of this is by getting proactive about it. And that leads to that leads right in, frankly, to the audit risk. Because if we start out at a point where we're saying, okay, I know what my taxes are going to be this next year, then we can build into that these kinds of questions. And we can say, what if I did deduct this RV? How much would that actually save me? And then we can, actually look at the number and say, okay, it'll save me 10,000. All right, how much is that worth changing my life? Or it'd save me, in some extreme examples, maybe it saved me 50,000. And is that worth, like, changing my circumstances in a more extreme way? Maybe. But those are individual questions. The point is, we have to actually set up the circumstances to be able to take a lot of these deductions. And in order to judge whether adjusting the circumstances is correct or not, you have to get proactive. You have to understand what your circumstance is, and how much you're going to benefit from these deductions. There's one more point that I wanted to say on, let's see, I gotta open this up. One more point that I wanted to say on deductions, which is there are a lot of things that are ordinary and necessary expenses that people will forget to take because what's going on? Let me see. Trying to connect to my iPad here. There are a lot of expenses that people will not take because they are just because they forget to, or because they're confused about how to take deductions that are split between business and personal. And I'm gonna sorry, I'm discombobulated today because I had to leave my office and come home, so I'm kind of doing this all in a scramble. But are you guys seeing my screen? Cressida, can you put it in here. Are you seeing my screen when I just switched to my iPad a second ago?
No, we're still seeing the same one that you had it on.
All
What is
right.
it, a deduction?
Oh, okay. I get it here. Just gonna share the whole screen. Share. Okay. Are you seeing that?
Yeah, that's working.
Perfect. So we have, within what I said, if we can make an expense ordinary and necessary, then it's completely deductible. And usually we'll have, something, this is how we usually talk about entity structures. We've got, your 1040 personal return up here, and usually there's a business return down here. And there are expenses that are 100% personal. These would include things like, haircuts and clothing and even like a car that we can't justify for business use, things that are clearly 100% personal, that there's nothing we can do to deduct them. And then there are things that are 100% business. So these would be things like professional services, like paying for a tax return is completely deductible. Paying for strategy or for an attorney for a business agreement is completely deductible. Paying for obviously any software costs, these are completely deductible. Things like then there are a few gray area things where the IRS has sort of just given up, and we can deduct them 100%. We don't have to play games, because the IRS has just said, all right, fine, just deduct it. So that would include things like your cell phone and your home internet. Those are things you can just run them through the business and pay for them through the business. So that you deduct them through the business, the cash comes out of the business, and they're completely deductible. And then there's a third category, which is like mixed expenses. And this would include things like, okay, we talked about ordinary and necessary. So let's say I wanted to take a trip to to Texas, but I wanted to deduct as much of that trip as possible. Oh yeah, and I wanted to bring my family with me, because I have a sister. I actually do have a sister who lives in Texas. How, like, this is in that gray area. So one, I need to make that trip ordinary and necessary first. So there are a lot of ways that I could do that. I could have a client in Texas and actually visit that client in person in an actual meeting. And now I've traveled to Texas to visit a client. And it just so happens that my sister's also there. And so I'm going to go visit her while I'm there. Or I could, if there was a vendor who lived in Texas, I could go visit that vendor if, like, the main software that I use happened to be there. Or, like, there are a number of ways that you can think about this and justify it. Those are the main two. There's another very common option is to say, every single year my company is going to have a shareholder meeting, and maybe that shareholder meeting, we always just go to an offsite place, and it's going to be, by the way, I'm that's me and my wife. So we're going to have the shareholder meeting, and maybe this year we're going to go do it in Alaska, even though there's no client, no vendor, nobody in Alaska. That's just where we're doing this annual shareholder meeting. But now I've got to actually go through and make the justification for that, which means I actually have to have the meeting. I have to document it. I have to, keep the notes, keep the meeting agenda. And now I have created a legitimate reason for me to go there for this shareholder meeting. But there's no reason for my kids to go with me. So there, now I've created an ordinary and necessary expense, but it's in this pot with a whole bunch of other expenses. Some are deductible, some aren't. And so for those, the way that we deduct those is with something called an accountable plan. And we have that. The template for the accountable plan is in the course. So you can go in and download that. But the accountable plan is the thing that's where we would say, all right, I bought all the tickets together, and they were, it all cost like $8,000. And of that 8,000, whatever it is, 3,000 is is the portion that's related to the business. And so accountable plan is essentially, another way to think of it is like a reimbursement form, but the business is going to reimburse me for that 3,000. And then maybe I spent, I don't know, whatever, 2,000 on hotels. Should get my colors right. 2,000 on hotels, but there were multiple nights, and like some of those nights were personal and some were business related. So I'm going to like divide that out and say, I'm just picking numbers here, but maybe half of it, 1,000, half of those nights were business and the other half were personal. And we use the accountable plan to divide all this stuff up. And one of the common ones that we're taking on the accountable plan is the home office deduction. And that's a classic example of how we divide it up, because we're dividing up the total cost of the home based on the square feet of office space within the home. And so we just use that percentage and then take that percentage of the overall costs associated with the home. That's what we're doing with the accountable plan. That is sort of how we account for that third category of expenses. So I'm going to jump to, actually, when I have my screen sharing like this, I can not see the chat, but here we go.
Yeah, we have a question in there.
Yeah, Megan, perfect. Do you have recommendations for ways to track mixed expenses? For example, just keep charges, expenses on separate accounts, credit card in real time, or take a percent of the whole expense. Want to deduct things that are justifiable and don't have to write down every single life detail somewhere. Yeah. So we can send you a link afterwards, Megan, to the accountable plan. But okay. Business expenses should come out of business cards. So that's what I was saying with like cell phones and home internet. I agree with what you're saying. The more you have in the accountable plan, the more you have that you're paying for out of your personal accounts that you have to get reimbursed for from the business, the more it becomes a nightmare. So I would put everything that's 100% through the business should be deducted directly through the business, like set up that cash payment to come right out of the business. And then with the accountable plan, those expenses should be paid for from your personal account, and then you reimburse them. So, what I was talking about with the hotel and cell phone, that would the hotel and the airfare, that would just come out of, I'd pay for that from a personal account and just remember it as a sort of a big line item. But then there will be other, on this example of this vacation, some of those meals, like down to the more granular level, some of those meals will be on days that are for business travel. And those I'm just going to pay for directly with my credit card, with my business card. So I don't have to put them on the accountable plan. I don't have to like keep track of all that. It's this meal is 100% a business expense. I'm going to pay for it with a business card. This meal is going to be 100% personal. I'm going to pay for it with a personal card. And that way it's only the big items that you're trying to divide up like that. All right. Let's see. Avoiding audit triggers. The first one is just being reasonable. Sometimes we'll see numbers from people where the business made $50,000 and they had $10,000 in meals expense and $15,000 in travel. And like in some cases that can be reasonable if it's legitimate, frankly. And it's someone who's a traveling consultant and they have to pay their own travel expenses, and like there are situations where it's reasonable, but not for most businesses, not for an accountant, not for a plumbing company, not for most marketing agencies or even realtors. It's you have to like put it in perspective and say, and that's where we come back to the ordinary thing. Is this like not just each individual expense, but is the total ordinary? And what we're talking about here is not even if each individual expense is technically deductible. It's a question of, do you want to deal with the audit and with everything that comes with it? And sometimes it's a lot easier, especially on some of those categories that the IRS is going to be looking for. You got to think about the IRS and understand that it's a bureaucracy, and there's a computer program that's just running and analyzing tax returns. And they're saying most companies in this industry of this size kind of have this level of expenses. And then there's this one that like sticks out like a sore thumb. That's the one that's going to be likely to trigger an audit. And in some cases, again, those expenses might be completely justified and we're okay with it. And we would say, yeah, I understand it might look suspicious, but I'm ready. If you're gonna come ask me the questions, I've got all the documents here and we're good. But just thinking about those ratios and with the reasonableness, it like that by itself puts a lot of things in the right context, and you can kind of look down your own numbers and say, maybe I'm overreaching on this one. And the other one is no even numbers, like back to the reasonableness. If it's just a red flag to the IRS to know that you're just guessing. So if your travel expenses are exactly $2,000 on the dot, well, what are the odds that they would be exactly that? And that's something the IRS will also can filter for in a computer program and look at and say, this looks like a number they just sort of picked as an approximate number and put in there. They probably can't justify it. So that's also likely to trigger an audit. The other thing is, the next thing is to just avoid desperation. This is a larger topic because people generally make bad choices when they make risky choices when they are feeling desperate. And that desperation usually comes, the way it usually goes is you get a tax bill that's huge and you say, oh, that's way more, like I'm not going to pay $15,000 to the IRS. So then you go back and say, oh, let me try and dig up some more expenses. And then you're retroactively going back and trying to find expenses and sort of just scraping everything up you possibly can. And that's usually when the overreaches happen and the poor decisions happen. And so a huge way, honestly, of avoiding audit risk is by planning ahead so that you can make some of these decisions consciously. And I'll go back to the car example. If her name was Laura. If Laura had gotten to the end of the year and thought, I didn't deduct my car. I'm not sure about the mileage. I'm not, I don't know what to do there. But she hadn't actually set up the mailbox and gone and like actually changed her circumstances at the time, but then went ahead and took the miles. That may not be an audit trigger by itself, but it is a huge audit risk because she won't have the supporting documentation if she does get audited. And so the more we can just shift our view from looking back and trying to figure out things that already happened and restructure things and then reach for things that already happened and change that to looking forward and saying, okay, I know my baseline. If I don't do anything, how much tax am I going to owe next April? And then I can start from there and make some like intentional choices on what I want to implement, what I want to deduct, how I can structure it now, how I can document it now. And we can do that with a clearer mind and be more intentional about how we structure the numbers and how we structure the circumstances to avoid putting ourselves in a bad spot. And then the third one is just putting our eggs in different baskets. And this just has to do with structurally thinking about what information is on your personal return. So let's see, share my screen again. If the IRS wants to audit you, and this is your personal return, and your business is run, right here on your personal return. So you're filing a Schedule C, and maybe you have rental properties. And all of these are just sitting here on your personal tax return. It's really easy for them. All they have to do is audit one return, and they can audit in that one return all of your financial information. If you instead have an S corporation that has your business is run through this S corp, and then your rentals are run through a family partnership, then the only thing that these two things are sending to your return is you have a K1 and a K1. And the K1s just report the income from these two business returns onto your personal return. Now, if you were to get audited here, first of all, the IRS is way less likely to audit you because you get a copy of this K1 that goes on your personal return, and the IRS gets a copy. So they already know, yeah, the copy we received matches what they reported on their return. It's nothing really to look at. And maybe there are some W-2 wages, and like those are really low audit risk because they're pretty straightforward as well. And your personal return all of a sudden looks really boring. There's not a lot to it. You got a couple forms, everything just exactly as it is on the form is what shows up on your personal tax return. There's nothing interesting on there. That where you took your home office deduction is here on the S Corp. All the remodels on your rental properties, they're over here on the partnership return. And now if the IRS wants to audit those, usually it's not even the same auditor, it's a different auditing team that's going to audit business returns. And B, you're in this pool of partnerships that of which there are probably many who are you're a minnow in that pond and probably not a huge audit risk. And as long as you're not throwing out any other red flags, your risk of being audited at all is pretty low. And you are like everything is fragmented. So even if your partnership did get audited, that's not the same thing. That's different information than what's in your S Corp. So it just really limits, and you have these different baskets, and the IRS could, of course, audit everything, but in practice, it doesn't usually happen like that. And so you're sort of limiting your risk by parceling out the different areas of your life and having everything just plug into your personal tax return through a boring tax form, through a K1, and that's it. All the exciting stuff is on these different business returns. So that is what I mean by, let's see, there we go. That's what I mean by putting eggs in a different basket. And let's see, Thomas, yeah. So does that mean if you have an LLC that passes through your personal return and no S Corp yet, you should take less deductions until you become an S Corp? Good question, Thomas. Kind of. Yeah. So it's not black and white, but yeah, I would 100% be more conservative about the deductions I take on a Schedule C than I would on an S Corp. Simply because the audit risk of a Schedule C just by itself is higher. The IRS kind of assumes that a Schedule C is kind of a solo entrepreneur who hasn't really gone to big business yet, and they probably have looser records, and there's just more likelihood that they can, if they dig, they'll find something. So audit risk in general with an LLC, within a Schedule C is higher than that same LLC filing as an S corporation. But also, you just have to be more transparent on a Schedule C than you do on a business return. So things like your home office, there's this kind of overplayed myth out there that the home office is like this crazy audit red flag. It's not, as long as, again, you're reasonable with it. The reason why it got that reputation is people were going way over the top with saying, 75% of my home is business related. And then of course, yeah, the IRS is going to ask some questions about that, but it's not as a rule. But on your Schedule C, you have to tell the IRS exactly, like you're reporting your square feet. It's this many feet that I use for the home office. It's this many feet total. These are all my expenses that I'm taking as part of my home office expense. So you're very transparent on a Schedule C. On an S Corp return, it's not transparent at all. It's all it is to the S Corp is rent expense or office expense. And it's a reimbursement to you. There's nowhere on the S Corp return that you're even saying that you're taking a home office expense. It's just sort of buried in the line item expenses. So yeah, I would be more conservative on a Schedule C, but that doesn't mean don't take legitimate business expenses. It just means kind of, think about it. Just understand there's a little bit more transparency and a little bit more audit risk. Let's see. That's it. Any other questions? Oh, here's just a question. Oh, that's yeah. Perfect. Thanks, Cressa. Really good point. Yeah, that list is meant to it's not intended to be like a comprehensive list, but it is a long list. It's not intended to be a comprehensive list. It's just intended to give you kind of get the juices going. And then from there, anything else you can take is just ordinary and necessary. Those are the criteria you have to meet. All right. Any other questions? You
Yeah,
can.
we have one from Thomas.
Oh, sorry, I see that. Okay, hey, Thomas. What's that? If the room you use for your home office space has shared use, i.e., part of a bathroom, should you? Yeah, it does need to be dedicated home office space. So, I mean, we get into like different circumstances there, Thomas, but if it's like a Jack and Jill bathroom or something where it's used also for personal stuff, then that's great. If it's like a bathroom attached to the office where you would only use it when you're working in the office, then I would go ahead and take it. Oh, bedroom, not bathroom. Sorry. Bedroom. Let me read your question again. Oh yeah, part of a bedroom. Oh, got it. I.e., part of a bedroom. Well, that question comes up a lot with like part of like if it's a bigger room, it's part of a family room, part of a what I would do in those cases is sort of draw kind of an imaginary line around it. As long as you're really using that space dedicated for work, let's say it's a big room, like I don't know. I'm not even I'm not an interior designer, so I try to picture a big room in my head and back into square feet. But let's just say the room is like, 30 feet by 50 feet. So like a big rectangle. And you're using a portion of that exclusively for your office, but it's not the entire room. You're fine. You just draw kind of an imaginary line around what is the space that's dedicated, and you can deduct that space. The thing you can't do is if you set up sometimes at your dining room table and like you work there sometimes, but also you eat dinner at the same table. That's something you could not take because it's not dedicated. Yeah, Cindy, we will have a recording that we'll send out. All right. Any other questions? You can put it in the chat, or if you want to raise your hand, I can unmute you and you can ask the question that way as well. Okay. Oh. There's a separate part of the bedroom that's just for, yeah, perfect. So yeah, just again, imaginary line around that, and that's your dedicated space. All right, awesome. Thanks everyone for attending, and we will send out the recording, and then we'll be back next Thursday. Thanks a bunch.